All right, guys, just quickly taking a look at a question here in the Q&A about the 3-month 10-year yield curve, saying that I read in an article that the 3-month 10-year curve recently inverted and that it means a recession is just around the corner now. Can we get any trade signals from this? So you are right. There are usually quite a lot said about the curves inverting. What now? Should we panic? Is it the end of the world? Is a recession imminent? But to be completely honest, when it comes to actual trade signals, I do find it entertaining to hear some of the takes associated with something like the 3-month 10-year spread inverting or the 2-10 spread inverting. But from a tradable perspective, I find it utterly useless as a means of finding tradable opportunities. And I'm going to explain why. Let's first talk about what exactly is the 3-month 10-year. Now, if we just quickly grab a hold of this chart, this shows us the 2s, which is the 10-year yield versus the 2-year yield. Now, most of you will be aware of what this one is. And if we take a look at the 3-month 10-year, that's basically just the 3-month yield versus the 10-year yield. You can see that one in blue, and you can also see that they move fairly in tandem with each other. Now, for those of you who are not familiar with what a 2-10 spread is, let's just quickly scoot on over to the terminal. For those of you who have access to the training center and have access to the Q&A training videos, if you just type in something like, if you just type in 2, you'll see that why the 2-10 spread matters. There's another one where we've spoken recently about the OAS, which one to use, OAS or nominal spread. So that's some information on what exactly that spread is. And also for those of you who have access to our macro fundamental masterclass, if you want a little bit more detail on exactly what those spreads are and how we use them, you can find module 2. We've got a section there about market-based leading indicators. You'll find the spreads in there. And we also have a lot to say about spreads, the different shapes of the curve, what it means, how we can use it in our fixed income section as well. So for those of you who have who want a little bit more detailed information on exactly what the different shapes and curves mean, you can just find that in the those modules. Now, in a quick nutshell, let's quickly take a look at what a normal US yield curve looks like. So let's just grab this chart. This was one that I used in the Q&A a bit earlier. Just give me a sec. There we go. So what we can see here is a typical US yield curve across various maturities. So let's first focus on the white dashed line we have here. This was the yield curve going back to earlier this year in January, basically 10 months ago. And this shows us what level of yield, what the level of yield was for each of the various maturities across the curve, going all the way from the 1-month bill all the way up to the 30-year long bond. Now, notice that this white dashed line is sloping upwards. And that is exactly what we would expect from a normal yield curve. The reason for this is that longer maturity bonds, i.e., everything from 5-year and upwards, they need to yield more, usually speaking, than shorter maturity bonds, because investors that invest and lock up their money for a longer time period needs to be compensated for the additional uncertainty of investing their money over a longer time horizon. However, various parts of the curve are driven by various drivers. The front end of the curve is mostly driven by actual short-term interest rates. So if the Fed funds rate is 3.125% like it is right now, then the 1 month should reflect the current rate plus the amount that the Fed is expected to increase in the next month or the next 2 months or the next 3 months. Now, that is a very oversimplified way of looking at it, but it will suffice for the purpose of this video. Then the further out the curve we go, there are other factors that drives yields. The further out we go, the higher things like your term premium becomes, which we can think of as the premium required to hold an investment over a longer period. Basically an uncertainty premium, if you want to put it that way. And the further out we go, the drivers also change from what the actual short-term rates are right now to what markets think short-term rates will be in the future. In other words, what will growth and inflation look like in 5 or 10 years from now, and how will that impact the federal funds rate at that time? So now we understand what drives the various parts of the curve. Now we can understand and take a look at the curve in blue, which is the one just a little bit higher. What you'll notice is that this curve looks completely different from the dashed white line that we have. This one doesn't slope to the upwards anymore. It's inverted, meaning that the shorter end of the shorter dated maturities is higher than the longer dated maturities. You can clearly see that the 3-month, the 6-month, the 1 year, the 2 year, the 3 year, they are all currently higher than the 10 and the 10 and the 30-year yield. So why is that? Well, again, it's caused by the drivers of the different parts of the curve. The front end is pushing up big time right now because the Fed is hiking rates aggressively. And we know that the front end is driven by the actual adjustments in rates. Now, while the long end is factoring in its future outlook for growth and inflation and telling us where they think short-term rates will be in the future based on that. So what does an inverted curve like this tell us then? That it's basically telling us that rates, short-term rates, are rising too fast. It means that short-term rates are rising so fast that it's deteriorating the future outlook for growth and inflation and causing lower yields for the longer dated maturities. Now, with this kept in mind, let's go to a chart where we can see both the 2-year spread and the infamous 10-year spread. Now, just give me a second because, like I said, I did look at this a little bit earlier. Let's just quickly find that chart. Pretty sure I have it here. Just give me a sec. Should be on here. Here we go. So what we can see here in blue, we've got the 2s, 10s, and in white, we've got the 3-month 10-year, 3-month 10-year yield. Now, what we can see from these two curves is that they've consistently told us more or less the same thing about the economic outlook, going back all the way to the 90s. Yes, sometimes the one inverts a little bit faster than the other. Sometimes the other one, reverts, if you want to call it that, a little bit faster than the other. But there's always a varying time lag between when they invert and the time when they signal a possible recession. And again, I'm not going to go into why it signals a possible recession. You guys can check out the videos that I spoke about earlier in this video to go into the recession probability signal that we get from this. But the point here is that both of them tells us pretty much the same thing. So why not just use both of them? Better yet, maybe let's not fixate on just one of these two and rather just track the economic data that feeds into these moves when they happen. Now, in terms of what things like investors mean from a forward return perspective, that's where we get into the signal of things. Can this give us a signal? Now that both of these two are inverted, what can we do of that in terms of trade signals? Well, I mean, not a lot. If you take a look at this research done by LPL, what we can see from this is that the forward return perspective makes them pretty useless as trade signals because the lags between inversion and actual recession and forward returns can vary greatly. If you take a look at this chart here, we can see that we have the S&P 500's forward returns after we've had the 3-month 10-year inversion. Now, as you can see, the 3-month, the 6-month, and the 1-year forward returns, it's a mixed bag to say the least. Their data suggests that the prior year's performance can strip out some of the noise in the signals, where stripping out your prior year where your return was negative, basically just looking at up years, you can see that gives you a close to flat 1-year forward return. If you only look at if you strip out the negative years, you can basically see that gives us a slightly better forward 1-year return of 7.3. So if this inverts and the prior year was down, we get a 7% average return. And if that happens in the same year that we get a midterm election, you actually have a 3-month return of 1.1, 6-month of 1.2, but a 1-year forward return of 15%. Now that starts to look interesting. If you look at that, some players will say, hey, wow, with a 15%, we are in a midterm election year, so with a 15% forward return expectation, let's just buy the S&P now. But it gets far less attractive when you understand that the sample size of that perfect environment is just 4, meaning it's just not worth using this as a signal by itself. So in a nutshell, is things like the 3-month 10-year yield spread, is it inverted right now? Yes. Should that be a surprise to us after all the data we've been looking at, after the 2s and 10s have been inverted recently? Not really, especially if you've been paying attention to the data. It was just a matter of time for that to start inverting based on where short-term interest rates are expected to go in the next 3 to 6 months. So it was inevitable for this to happen, and it's just not something that we will look to take any real trades on. So use the spread as an additional as an additional market-based leading economic indicator, but do be careful using it as a signal on its own to buy or sell anything. I think that's where things get a little bit dangerous.